Curinos end. Ken, Senior Manager, our retail lending business, and Kinley Hicks is a Senior Associate too, as well as Steve Stipper, Managing Director for LendTrade. So excited to have Ken, Kinley, and Steve with us today, and certainly looking forward to today's conversation. A little bit about our two companies before we dive into the agenda. So Curinos brings together the industry exclusive expertise, insights, and analytical firepower that fuel a strategic competitive advantage. We've got a suite of predictive analytics, science-based platforms, and decision tools driven by our vast proprietary data. So our clients are able to identify emerging market opportunities and make informed decisions that drive sustained improvements to performance. LendTrade is a capital markets advisory firm connecting buyers and sellers of loans. It's inclusive of whole loan sales, participations, and forward flow arrangements. Although we'll just be talking about home equity today, product types include residential mortgages and consumer loans as well. The company was founded in 2000 and is based in Des Moines, Iowa. So today's agenda, we'll jump right into it. Talk a little bit about the economic update, what's going out there in the market today, and particularly why is home equity so popular right now? Something we talk about on the Curinos side, and I'm sure Steve at LendTrade. It's hard to have a lending conversation in today's environment without talking about home equity. So we'll dig into, again, why we're starting to see this resurgence of home equity. We'll talk about the state of home equity lending. So in terms of what's happening in that space today, what we see as far as kind of forward outlook as well. A capital markets date as well. So Steve's going to dig into, hey, what are we seeing from a capital markets perspective, deal flow basis. We'll talk a little bit about data-driven portfolio insights. So it gets into asset performance. How are these home equity assets performing today, and how have they performed historically? And then really the key takeaways of what should lenders be thinking about right now. So for folks on today's webinar, maybe many of you already are in the home equity space. Maybe some of you are looking to enter the home equity space, but certainly wanting to get a sense, hey, what should be top of mind? What should be kind of key questions you're asking or discussing internally? So with that, we'll jump in on our economic update. Again, why is home equity so popular right now? And with that, I'll kick it over to you, Ken.
Great. Thanks, Rich. So really key theme here is why in the heck is home equity so popular? This is one of the, I feel like, rare shining moments that home equity gets more than a couple of months, their time in the sun. And we've got a really good runway ahead for home equity. So thinking about it from economic trends, here's the latest. Obviously, this is a very, very big week in terms of reporting. Got GDP, PCE, jobs report, and of course, the famous Fed meeting all this week. So a lot of the stories we're going to tell today could very much be vastly impacted based on some of the news that comes out by the end of this week. But here's what we know for now. A couple of key themes here. What we have, Curinos has measured historically is home equity demand kind of correlates with customer sentiment. So really looking in that bottom left, we're sitting at lower levels, really about 2-decade lows from a customer sentiment standpoint. So we see that as a headwind, but we are improving. It doesn't feel like it just because we've been sitting at such lower levels, but we are improving for the most part. But as we think about, things like unemployment, the price index, these are all tailwinds more for the benefit of home equity growth. So again, no one really loves if you're a buyer right now from a home price index, but it certainly helps keep borrowers in their home for longer. It does challenge home affordability, which I know in a lot of first mortgage lenders, they don't like to hear that, but it certainly keeps borrowers in their homes for longer, forces them to make improvements to the homes that they're in rather than looking for the next home up, to get up on a grander scale. So that's great news for our home equity lenders. The rate environment, we got the full point cut by the end of Q4 of last year. So really good news for home equity lending. Kind of a mixed bag when we look at the rest of this year. We hope to get a little bit more feedback from the Fed throughout this week on where we think rates are headed. But from the Board of Governors thinking maybe 1 to 2 cuts by the end of this year, and then things seemingly will start to open up a little bit more as we head into 26 with a couple of cuts by the end of next year. Couple of things to really monitor. A few of you have probably heard us talk about this before, is some potential challenges of headwinds that we need to be mindful of. So again, the customer sentiment that we talked about before. Household savings rates were at 2.5-decade lows. So consumers' dollars are not going as far. Payrolls are not keeping up at the pace of that consumer price index that you see there on the right. And this is all keeping things afloat, and consumers are still becoming very resilient to a lot of these headwinds because of that upper left that we talk about. Unemployment, it still remains relatively low. So we just need to watch and balance for if consumers' dollars aren't going further, are they using home equity for the right reasons? We'll take utilization all day long, but need to make sure we see some of those challenges that start to come out to too high of utilization for certain classes, as well as some of the leading indicators on delinquency trends, on stressed cash flows for borrowers, which we'll get into. If we go to the next slide, this kind of helps spell out a little bit more from an opportunity standpoint. Again, it's no question, consumers continue to spend. And this is also alongside of, things are more expensive. So we're certainly going to track upwards here on that total consumer debt scale. So if you look at right at 2021 through, I believe this is June of 2025 data. So we're up 24%. Now, again, this is household and non-household total debt. But if you look at this 24%, and again, your payroll is not going as far, this becomes a challenge for consumers. And this really spells out a very beneficial, very opportune time for home equity lenders to thrive right now and to be able to help deliver better financial tools to their consumers to help ease some of those cash flow constraints. Mind you, they're sitting on a ton of equity in which a home equity tool can certainly do a lot of the heavy lifting there for those borrowers. The last piece before we move on here is you look at some of those other segments, especially credit card. Again, we're looking at average credit card rates probably north of 25%. I think we're rounding right about 1.3 trillion in total credit card balances outstanding. But if you look at that bar, it doesn't look like it's growing all that much. But if we were to actually look at that same 2021 to 2025 timeframe, it's actually at about a 22% growth rate. So it doesn't look big, but seeing that type of growth in just that one class, in addition to, again, 25% plus interest rates, this again just spells out just a real opportunity to help our borrowers, help our homeowners out, be able to leverage that equity in their home and help improve those cash flows. So we love this slide because, again, as a longtime home equity advocate, we look at it as this really just helps pave the way forward for home equity lending. What I'd like to think for the next at least 12 to 18 months. And I've been using that 12 to 18 months for a couple of months now, but I'm going to keep on that track of there's just a really robust runway ahead for home equity. The two biggest stats here are, number one, we still have virtually 2/3 of lender or of existing first mortgage holders sitting at a 4.5% rate or lower. So no matter what side of the fence you are on in terms of rates, if we get to anywhere in the 4.5% range in the next 12 to 18 months, I think we've got a lot bigger problems that we're going to be facing. So I don't anticipate us getting there. But what the right is trying to depict here is just how far do rates have to drop for it to make more economic sense for homeowners to leverage a first mortgage cash out refinance as opposed to using a HELOC or even a closed-end home equity loan. So put your calculators away, don't do the total calculations, but just using some rough math, we're somewhere in that 4 3/8 to 4.5% range before it's going to start making more economic sense to leverage a mortgage cash out refi as opposed to using a HELOC while keeping that first secure and just leveraging the equity cash out using a second lien product. So again, no matter what side of the fence you're on from that aspect, I think we can all agree that we've got a pretty clear road ahead for home equity lending to continue to thrive. But the landscape is changing. And that's really the important part to one of your takeaways today is the landscape that we're in right now for home equity lending is not the same landscape to even 5 years ago, certainly 7 to 10 years ago. So as we think about all the tappable equity, roughly about $18 trillion that homeowners are sitting on right now, it is fair game. We're seeing IMBs jump into the game here. We're seeing servicers jump into the game, fintechs, as everybody knows. So this market share that depository lenders held, which was virtually 100%, 5, 6, 7 years ago, it's still vastly held with depositories. And I'm going to be really excited when Steve gets a chance to talk about this, of why this is appealing, why this market is appealing not just to depositories any longer. Depositories do have to watch what's going on. This landscape and this market is vastly changing based upon the appetite from a diverse number of institution types. But as we stand right now, this was through the end of last year, depositories still hold about 80% of the total market share. And then those non-depository home equity originators and the HEI products taking on that 20%. Again, that's a very, very big shift in a very, very short time frame. And then lastly, to take us out here, before we hit the next section, is just, well, we talked about the debt, we talked about the headwinds and tailwinds from an economic standpoint. We got to look at the homeowner tenure. And we kind of mentioned that before, people staying in their homes longer, making those home improvements. They've got the debt challenge that they're trying to hurdle. But we're really looking at two core metrics. Home prices are going up nationally, and the tenure in homes is staying up. So we're sitting at about 12 years, people staying in homes. So as that HPI continues to increase and we're sitting at those more elevated interest rates, that home affordability is going to continue to be a challenge. So again, just kind of a third lever there of why home equity, why we feel home equity is going to continue to thrive here very much over the next couple of quarters. Let me pause there. That was a ton of info. Rich, anything further you want to add, or any questions in the chat that we can address?
I think we're good on questions. Nothing yet in the chat. So just for those attending and listening, we are going to be looking to take questions throughout, and then we'll have some Q&A here at the end. But no, I think Ken, you did a nice job, kind of what we're seeing at a macro level. And again, I think underlying most of that is we are cautiously optimistic in terms of the outlook, kind of where we sit today, where we expect to be. I'll use Ken's line in the next 12 to 18 months, since that seems to be the right sort of time horizon to evaluate things. We'll jump into the state of home equity lending. I'll mention briefly for these views. So at Curinos, we aggregate lender supply data. So everything you see here is going to be derived from our proprietary data. It tracks approaching now about 60% of the home equity origination and portfolio markets. But I figure, well, we always get that question in these types of settings. But everything you're looking at, the underlying data itself, is provided by our benchmark participants. So with that, Ken, I will turn it back to you.
Great, thanks. Okay, so I amped up home equity of we've got a lot going for us. Now, how are we actually doing? So as Rich mentioned, we get our data proprietary through our benchmark of home equity lenders. So we see application volume and booked volume. So through the first half of 25 on the left-hand side, from H1 25 versus H1 24, applications are up 11%. So I will take double-digit growth no matter the scenario, and we continue to track towards that the further that we get into 25. Last year shows that 3% number. I'll kind of asterisk that if I broke this down by quarter. The Q1 through Q3 of last year was kind of mediocre. It was okay, but it was really Q4 that saved us. And with the Fed's cutting rates, that really kind of jump-started a lot of the home equity volume. So Q4 really pulled 24 out into a positive application growth year. And because of cycle times, we didn't see a lot of those originations happen until 25. So if we look on the right-hand side, 24 actually showed -2% in total originations year over year. But for the first half of this year, again, fueled by a lot of what happened from applications in the late 24, came through in 25. So we're up nearly 20%. It's 18%, but I like saying nearly 20% because that sounds a lot better. But one really important thing here, and we work with a lot of our clients on this, is what's working well. What's allowing lenders to see some of this massive growth, because we see some lenders that are up 30, 40% versus last year. And these are not small institutions. One thing that we see is very, very apparent is the use of intro rates, or what we like to call teaser rates. Call it your 6-month intros, at a reduced margin. So it's nearly a third of HELOCs being originated this year are leveraging some sort of intro rate. That's massive. If you think about what was that in 24 and 23, that number was in the maybe the mid-teens to low teens. So we're seeing a lot of lenders, specifically depositories, now get access back to marketing dollars, and they're seeing the opportunity of rates got cut. This is opening up more dynamic for home equity for maybe rate sensitive borrowers that don't want to put in that swimming pool with something with an 8 or 9 handle on it. So now it comes back a little bit. We see the immediate demand there in the applications at the end of 2024. And now lenders are recognizing that if we give up a little bit more margin and incentivize those borrowers to take a higher draw at close, or incentivize more of those rate sensitive borrowers to look at doing a home equity, it's very much been a winning recipe. So we're happy to always discuss some of those details if you want to shoot us a note later, but it's a really great strategy. I know you're either on the fence of you either love promos or hate promos, but we can tell you promos do work as long as they're executed right. And clearly a lot of that volume and growth that we're seeing this year, and that 18% annualized growth, is attributed to a lot to promo usage. So where does home equity look for the rest of this year? So we don't have a 26 forecast out yet. That's going to be coming soon. But this is proprietary to Curinos. So we worked really hard in putting together kind of really the industry's first forecast view into home equity. So if we look at where we're tracking for 2025, again, gave you the results on the prior slide of H1. We're about 18% up year over year. So we were tracking at about 9 to 12%. So actually forecasts are actuals are well above our original forecast. We do see things slowing a little bit. So we're kind of backing that down to about 3 to 6% for the second half of 2025. I don't think we have time today to get into all of the details as to why is it backing off, but a lot of it is because, again, Q4 of last year was one of the biggest application and also bookings origination quarters that we saw in a very, very long time. So it's going to be really hard to catapult ourselves and get beyond those Q4 levels. But Q3, with what applications we're seeing, we see a very robust Q3 and the normal seasonality that we hit in Q4, but still a pretty robust environment. So this year, we're still sticking to it right now, but we're in that 6 to 10% annualized growth range for 2025 as a whole, which I think is phenomenal, just given some of the headwinds and tailwinds that we talked about earlier. If we squeak out a double-digit growth here, I think we're onto something here. In terms of the dynamics of, we get the question a lot of, well, how are lenders growing outside of promos? Are they becoming more in tune with, growing their credit risk appetite? Which way are they going? So this is the benefit of leveraging benchmark data, is just understanding what the other team's doing, how the market is shifting. So this is just a really quick and easy snapshot with 3 metrics here of CLTV, which is combined loan to value distribution. The middle there is going to be credit score distribution, and the right is going to be debt to income distribution. So just to get the right out of the way, DTI distribution pretty much flat year over year. A little bit of change, but we're not seeing much change year over year between lender appetite. But if I take your eyes all the way back to the left, we look at this and say, we're seeing more originations in that less than 60%. So it's close to now virtually 50% of originations are now under 60% CLTV. So some of you might be saying, well, Ken, that's kind of unfair to say lenders are becoming or skewing more towards the lower risk segment. I would agree with that, because I think HPI and the HPI growth is growing a lot of that. Of just more HELOCs and home equity loans, or specifically just defaulting into lower CLTV segments. But if you look at the middle, it's telling a similar story, which is they're also originating to more premium credit score borrowers, 800 plus. So if you look at 24, it's about 35% of total originations and 800 plus. This year, we're closing in on 40%, so we're at 39%. So some of you might say, well, that's just more FICO migration or scores improving. I would believe that if we saw that middle band 750 to 799 shifting, we're actually seeing the shift from those lower bands contract, and it's going towards those 800 plus. So this could be a byproduct of more price sensitive customers who tend to be in the more premium credit tranches now getting off the bench, and now they're originating. So we're going to see an influence there. But a second piece, which we know to be true, but I think is just another part of the story, is I think some lenders are just trying to be a little bit more cautious. So they're attributing a lot more of their originations, a lot of their direct marketing towards those premium credit score borrowers. And then lastly here, we can't have a home equity conversation about talking about the problem statement here, which is the cycle times. So in this view, this is primarily going to be more of a depository flavor of just either banks and credit unions. But, this is really the problem statement as we kind of make our way through today's conversation. And again, with the influence now of 15% of the market now belongs to IMBs and fintechs, we've got some folks on our tail. If you're depository, you've got to be looking and trying to improve the process and make the customer experience that much better, because we're still sitting on 40 plus days in total cycle times. We added that unsecured flavor in there right on the bottom. We're trending right around 5 days for the last several quarters. So this is more of that speed versus need. Is price all that relevant if I can get my needs satisfied through another product or another institution type? Even if the price might be vastly different, my need is today, it's not 40 days from now. So just something to be mindful of this dynamic hasn't changed historically. We're still sitting at 40 days, but it's something that's a very obvious trend that should be addressed to ensure that we're keeping up with consumer demand and consumer preferences. Rich, before we go to Steve's capital market section, any questions in the queue that we can address?
Yeah, I'll take, let me go back to 15 because we want that, the chart will help. So question was on the declines in mortgage refi cycle times. Do HELOCs lose some of their advantage? I think the question was more around, we're looking at kind of that gray line representing mortgage cycle, but as we've seen that kind of come down, say closer, right, tighten relative to where we see those cycle times for HELOC or HELOAN. Does that play into it, you think, from a advantageous perspective of, hey, we can close the mortgage option quicker than we had in the past? Maybe elaborate on that if you can.
It's a great question. My personal belief is you really don't start making a meaningful impact until it's obvious. So if we're all sitting in 30 days plus, I know it says 40 on the page, but just hypothetically, if we're all 30 days plus and you have alternatives are within days, that is a very obvious shift or a very obvious difference. So I've always been a firm believer in working with our clients that consumers are not calling and shopping for who can offer the fastest speed. But when it becomes very obvious that this process is going to be a month or longer versus maybe a week to week and a half, then I think it becomes obvious. So to answer your question, I don't think it's really hurting. It's not helping, but it's not hurting home equity, given everybody in that kind of real estate secured bucket that we're displaying here is well over a month.
And then a follow-up, Ken, we had a separate question, but related. Obviously, this is tracking our aggregate benchmark. Do you have a sense for cycle times for fintechs or HEIs? Kind of, if we're at 42 in aggregate, kind of, and again, fintechs and others competing on speed and convenience, do you have a sense for maybe just what an average cycle time looks like for some of the new entrants, fintechs? And then if we do have market color on HEIs as well.
Yeah, to be fair, I don't have any context on HEI for the home equity investments. I feel like I could take a really good guess based on what I know, but let's table guesses for today's webinar. But for fintech specifically, we're tracking right around 10 days. And again, that's kind of an average. So you have to think about, how much is closing in 5 days or less, or 7 days or less. So you're probably talking the vast majority being closed within a week. And then the other 50% is kind of a smattering, but it's in general, those pipelines season out and mature very quickly, well within 2 to 3 weeks.
All right, I'm going to kick it over to, we got a couple other questions I'll try to get to here after the next section, because I think Steve, you'll highlight a little bit. There was a question around less risk, assuming most of these are portfolio loans or tighter lending parameters. I think you can see that from your side as well. But yeah, let's jump in. Former capital markets guy myself, so Steve, I'm certainly interested in what you have to say. But we've been looking on the front end, obviously, what we track from a Curinos side. Now we kind of go to the back end or secondary markets. So yeah, with that, Steve, I'll turn it over to you.
Okay, thanks, Rich. Just making sure my video is working. I've had some glitches on that today. All right, sounds good. All right, so let's dive in. I think one of the key things that has happened over the past several years is that the investor demand, not only the borrower demand, but the investor demand has been surging. And that's a function of rates going up. So obviously, insurance companies, banks, credit unions, they like higher rates, and they're happy to see that happen on part of their assets. And so they're able to get more net interest margin. And particularly, I think the insurance companies. So if you were to go back, 4 or 5 years, home equity rates were in the, call it 5.5 to 6 range. And now a lot of the rates that we'd see, particularly the things that are getting securitized, are more in an 8.5 to 10 range. So you've got about a 300 to 400 basis point increase, which again makes sense when you think about what's happened with the Fed moving rates over the past several years. There's a lot more interest in that. That interest rate adjustment makes it attractive for insurance companies and other securitizers to get in this business again. And basically that's brought more of an originate to sell model back. As Ken talked about a little bit earlier, you're seeing more mortgage bankers and non-depositories getting back into this market. Whereas for a long time, most of the participants were banks and credit unions, and they were really originating this asset class to hold on balance sheet. As it relates to the capital markets, you had banks and credit unions buying from other depositories, and there were some non-banks that were originating, but certainly not at the scale that's been happening now. So what's starting to happen now is that those insurance companies and other asset managers are creating what I call, what I would consider a pull strategy, where they're saying, go out and originate these loans for me now, as opposed to before where different companies were originating and then trying to find a buyer. So it's just a little bit different approach now to what we're seeing. So I think we can go ahead and move over to the next slide if you would, Rich. So let's talk a little bit about securitization, because I think this is really important to understand, and I think it's very consequential for the folks on this call. So if you really go back to 2008 and the great financial crisis, home equity, it was a very different asset class back then. Very high combined loan to values, which are very different than today's product, which, as Ken mentioned earlier, is probably a combined loan to value in the 60s on most loans, whereas back then it was something in the 90s. So basically in 2008, securitization stopped. And from then through 2022, there really wasn't any, essentially any public securitizations happening in the home equity space. As rates went up in 22, you started to see some issuance in 2023, but it was just a very small amount. Last year, we had the first real consequential amount of securitizations, which was about just shy of $6 billion. This year, if you take the year-to-date numbers, extrapolated out for the year, we expect that there'll be something like $20 billion. Maybe it'll be a little bit higher than that, but that's about a 4 times growth this year. And so what you're really seeing is there's kind of a chicken and egg here too. The fact that borrowers like this asset class has made it more attractive for insurance companies and other buyers of asset-backed securities. That's also making it easier to originate certain loans as a mortgage banker. And so that's it's really positive feedback loop on both sides that we're starting to see with the resurgence of alternative investors versus just banks and credit unions. Okay, I think that's kind of it for that slide. Okay, I think this is really a really important point, particularly for non-depositories and mortgage bankers. So, banks and credit unions have been in this space for a long time, and they can originate loans for their own balance sheet. But, non-depositories, they need external sources of liquidity that are sustainable for them to be able to participate in the space. Most mortgage banks can't risk originating a loan unless they know that they've got a committed buyer. So they need certainty around underwriting guidelines and pricing. And so what's happened now that there's this strong investor demand for securitizations, it's fueling a rebirth in correspondent programs for home equity that really, has been percolating for the past several years, but prior to that had really, again, been dormant since 2008. So the rebirth of those correspondent programs is making it possible for non-depositories to get clarity on what loans are going to be eligible and what the pricing is. And that allows them to have comfort in going out and making commitments to borrowers. There are also obviously whole loan buyers and credit unions that are buying participations. But I think one of the key variables is just the securitization market coming back has made it possible for these correspondent programs to give loan level eligibility so that, it's kind of rebuilding that whole food chain from origination to securitization. That's it on that one. Okay. So there's a couple of things I want to point out here. And I think this is, one thing that I hear a lot when I'm talking to banks and credit unions or other folks that are participating in the space is that the nomenclature gets interesting. So people think of HELOCs as kind of what we're talking about, but I like to say there's kind of 31 flavors of Baskin Robbins when it comes to home equity. You've got, is it a line of credit versus a closed-end second? Is it a piggyback versus a standalone? Is it well utilized or not utilized? And so I'm just going to talk about a couple of the broad categories here. So when we talk about closed-end seconds, what we're really talking about is a fixed amortizing loan that's more like a first mortgage. There's no future draws. It has a fixed rate. And I think that's really important as we talk about the securitization model. Fixed rates are a lot easier for the securitization folks to model because it's an amortized loan over a fixed term. It's also easier to calculate debt to income because the payment's fixed. And those closed-end seconds are subject to TRID. On the flip side of that, you've got HELOCs, which is an interest-only draw period, and that's typically 3 to 10 years, followed by a repayment period. The future draws, require available cash on reserve when the borrower requests them. And so that, by definition, that makes them a little bit tougher to securitize. And by no means does that mean that the securitization market won't do HELOCs. It's just some of the features and the way they get originated and the structure of those loans will be different if it's intended for securitization versus a bank. For example, a bank might put it on balance sheet and it has a very low utilization. It allows the borrower to tap that over time. But the things that go into securitization, the securitizers really want to try to see where it's a high utilization. And so I guess what I'm trying to get at here is the product will be a little bit different in terms of who the end investor is intended to be. And HELOCs are exempt from ATR, so they're not subject to TRID. So that there are a lot of originators will focus more on HELOCs because there are certain advantages, or they'll focus on closed-end seconds. Okay, I think that's it on that one, Rich. So I wanted to give just a kind of a comparison of different, 3 different buckets here. So you've got securitized closed-end seconds, you've got securitized HELOCs, and I'm going to use Figure as an example of that. And then the last alternative is a depository HELOC, which is coming from Curinos in terms of their data. So the one thing I want to point out here is that the rates on the securitized product tend to be a little bit higher than what's going to happen on the bank balance sheet. And the FICOs are still extremely strong. So you're a 740 FICO. But if you look at the bank product, that's a 787. So there's definitely in aggregate, banks are providing, credit to really super prime borrowers. The combined loan to values are pretty close. So as I mentioned, we're seeing things in the mid to upper 60s, which again is very different than the, prior time period before the GFC. DTIs are in the high 30s, but then I think the term is really important here. So when you see things on the closed-end seconds tend to be a 20 or 25-year term, and it's an amortized loan. Whereas the HELOCs, they're going to have a draw period that's interest only for a period of time, followed by amortization. And as I mentioned, the securitized HELOCs tend to have a shorter draw period because it works a little bit better with the securitization. The last piece I think that's important here that I really want to point out is the utilization. So obviously on a closed-end second, it's just a straight loan. There's no available credit. On the securitized HELOCs, they tend to be very highly utilized out the gate, and that's done by design. If you're selling a loan and you're selling a HELOC, you want to get paid. You want to get paid a premium on that loan, and that's going to be based on what the or the existing utilized balance is. So as you see on the depository HELOC, there's only about $50,000 utilized on a $125,000 line. So that's a pretty low utilization, which means that fits okay on a bank because the bank can provide a draw later on, but that doesn't work quite as well on the securitization side.
Steve, we had a question come in just on closing costs. Is that a metric here, component that's tracked in some of these pre-sale reports?
I don't have that data on hand. I think, what I'm seeing, I think again, it varies by originator in terms of what they're doing. Some are charging, points and fees up front. Some are just trying to make a premium on the backside. And again, I think that's also different between depository type originators and the securitization market. But I don't have good data. And I think a lot of that is, maybe available, but I don't have access to that, I guess, at this point.
Totally fair. Now, there was a question, I think we touched on it, and I think the short answer is yes, we have it available, certainly on the Curinos side. There's a question on year-over-year data showing kind of these interest rate, or these are WACs, but interest rate averages by product type. So looking at close-end versus HELOC, and then also by lender type and credit score range. So maybe I'll just take that one. That's data we have, and those dimensions of that specific data we do track on the Curinos side. So that's something we'll include contact information at the Q&A, but that's certainly something not in the deck for today, but certainly something we have access to at the Curinos side.
Yeah, and I think the last thing I'll kind of mention about closed-end seconds versus HELOCs, and this is just really kind of tie some of the earlier comments together, is there are pros and cons to each, and I think it really depends on what loan type you're trying to originate. So again, closed-end seconds, the benefits, there's fixed rates, there's a fixed amortization. It's more like a first mortgage, and the securitization markets prefer that. That's not to say that they don't like HELOCs as well. It's just more complicated because on the HELOC side, you've got more rate complexity. It's harder to model. There's unpredictable balances. And so what you tend to see is that banks and credit unions, if they're the buyer, they tend to like HELOCs a little better on average. On the securitization side, they prefer the closed-end second. So I guess one point I'm making here is really that it depends on who's going to be buying it in terms of what that product ends up looking like. So I think just some of the key takeaways is that, again, I think people throw out the term home equity and they assume that really means the same thing to everybody, and that's not really the case. There's a wide range of what those products look like in the marketplace. As I mentioned, HELOCs are a little harder to securitize and also probably more difficult to originate. And given the lack of standardized guidelines, I think one of the key things here is just, it's important as you start to roll these products out to make sure that you're working with the right partner and that you've got your infrastructure and tech stack developed to be able to produce these. So like, for example, HELOCs, you need to have docs that are aligned with that buyer because of all the draw features and things like that. So I think that's it for me.
Yeah. Steve, actually, maybe one last question. It didn't come in the chat, but I know one I've thought about is from like a deal size perspective. I mean, is there a sweet spot as far as like folks listening and wanting to get into home equity? Like, is there I'm sure there's a minimum volume target, but maybe a little bit of color there on, hey, what's
Sure.
critical mass that would attract, enough investor demand here where I could actually take advantage.
Yeah, good point. I think the way I would answer that is that historically, or over the past several years, that's probably been, it just depends on who the buyer is. And if it's a bulk portfolio buyer or someone buying participations, that could be 10 million on the minimum, and somebody might say, hey, we want 50 or 100 million on the maximum. But I think what's happened now, as I mentioned before, now that these correspondent programs have reemerged, there are plenty of people that are out there that want to buy even on a loan by loan basis. So I think, again, what you have now is there are options for really any sweet spot that you may have, and so it's just a function of trying to find the right partner for that.
Right. So we've covered kind of liquidity, what's happened on the capital market side. Thanks, Steve. We'll switch gears a little bit. So obviously relevant to the conversation, but portfolio insights. So leveraging again the data we have at the Curinos side. But how do these assets perform over time, right? It's great that you have the liquidity, but if there isn't strong performance in the asset class, you'll have another kind of challenge to overcome. So with that, Kinley, I will turn it over to you.
Yeah, so I think we touched a little bit on the origination side. It's looking great on the origination side, right? 18% up year for 2025, seeing really good growth. But at the end of the day, that only really matters if you're also getting good balance growth, because you don't want to be originating widgets and having those sit empty, unutilized on your books. So this paints a really good picture for the past 3 years. But if you kind of track back to 2015, over the 10-year span, I think you go from 2015 down to about 2022, and we were seeing some really bad kind of balance rundowns. We were seeing balances kind of go down over a 7-year span. But if you look at 2023, we actually started to see positive balance growth, and that hasn't really slowed down. We've been seeing really good year-over-year balance growth ever since. And so you see on the side of the originations, we're seeing good growth for 2025, and we're also seeing really good balance growth as well. So it's not only are we originating widgets, we're also seeing people take draws on these HELOCs that are originating, and we're seeing good balance growth on the portfolio side once these do get funded. Yeah, on the flip side, if you pay attention here, the way to look at this is just year over year, calendar year, 2021 through present, and you can see average line sizes are the biggest mover here. You can see they've gone from about 100,000 on average in 2021 to about 122 in 2025. So while we're seeing good balance growth, on the flip side, we have still been seeing some challenge utilization rates. So if you pay attention to just those line sizes, they continue to increase year over year. 2024 to 2025 has slowed a little bit. So it's only 1.4% up, and we've actually seen balances outpace that. So balances are up about 3.1%. So we're seeing balance growth outpace line size growth currently, and that's where you can see kind of that inflection point on utilization rates in 2024, where we're finally starting to see those come back up. So sitting at about 36%. So as Steve was talking about, those utilization rates for depositories do sit at about 36%. That's what we're seeing on the portfolio side. Those HELOC utilization rates do hover right around 36%. Yeah, so looking at the second lien home equity balance runoff, so balance paydowns in the blue, balance payoffs and closes in the gray. I think for both HELOCs on the left and HELOANs on the right, that balance paydown was the worst, I think, in 2021, 2022. That's where we kind of saw in 2020, 2021, the highest savings rates for households. We were seeing a lot of balance paydowns, balance close. But if you look on HELOCs, it's been trending back up. We're down to about 24.6% balance paydowns, about 9% on balance payoffs for 2025. I think HELOANs are more so in kind of that steady paydown speed. If you look, 21, 22 was a little bit more severe than 23, 24, 25. But if you pay attention to balance payoffs and balance closings from 24 to 25, that is starting to get a little bit steeper. So it is something to pay attention to as we're seeing those HELOANs on average, the rates of where they're sitting in the portfolio. We are starting to see both those balance pay down percentages and the balance payoffs and close get a little bit more severe for 2025. Yeah, and so on that note, this is as of May 2025. Each of these axes are going to be vintage years. So this is just a snapshot of portfolios for May of 2025. So if you look at the 23, 24, 25 vintage versus everything before 2023, I think there's a very obvious difference. You can see everything that's been originated in the past 3 years is sitting pretty heavy in those 6+% interest rates. If you look at 2015, 16, 17 onwards through 2022, you have a lot of those HE loans that are sitting in the less than 6% interest rate. So those folks likely for a while are not going anywhere. Those are the ones that we do see probably just in a steady paying your monthly payments, not really likely a flight risk. But if you pay attention to that 2023 vintage and onwards, you do have a lot of folks sitting in that 8 to 10+% interest rate. So as we think about rate cuts and sort of that prime rate coming down, those are the folks that we see as the highest flight risk, just as interest rates come down and they think they can get a better interest rate elsewhere. If you pay attention to HELOC average balances trends, I think we were looking just kind of on a trend year over year. This one is a little bit of a different flavor, paying attention by vintage year. I think the big standout here is 2025 is a phenomenal year for average balance trends. We are tracking higher than any of the other recent vintages in the past decade. I think that 2015 to 2018 line is kind of on the bottom. I think as we saw, line sizes have been increasing. Average balances do tend to follow, even though utilization trends perhaps have not followed followed suit. But if you're paying attention to that 2025 vintage, average balances are performing really, really well. And that in part is due to a lot of what we've been talking about, the promo rates that lenders have been offering. It's a good motivator to get folks off the sideline, to get folks to take a draw. And as you think about on the origination side, having more folks come in on those higher credit score ranges, typically those are the folks that we expect to have lower utilization rates, and they don't take as much of a draw. But even with higher credit scores and higher or lower CLTV ranges, and on average, we're still seeing really good average balance ranges. So we're seeing that is looking great, and hopefully that trend will continue. The other main call out here is if you look at some of those middle vintages that originated at much higher rates, that 2024 vintage, the 2020 vintage, we're seeing the tails start to tick back up as well. So I think folks, if you pay attention to some of those older vintages, that's really flat or on a decline. Some of the middle year vintages that have been at higher rates, we're starting to see tick back up. So as rates come down, I think folks are beginning to take advantage of lower interest rates and maybe have been waiting for interest rates to go back down to tackle that kitchen renovation or to put in a pool in the backyard or any sort of debt consolidation, however they choose to activate their HELOC. And so we're starting to see not only really good starting balances for recent vintages, but some increases on balances for some older vintages as well. And in positive news, they're performing very well as well. If you look at that 10-year average delinquency rate, it hovers at about 1.5, 1.6%, just in terms of delinquency trends. This is a 30-day plus balance weighted. But if you look from 2021 to 2022, we saw those come down. HE loan delinquency rates have kind of been trending downwards and flatlining from 24 to 25, really no signs of elevated risk, and much lower rates of delinquency than historically over the past 10 years. If you look at those HELOCs, also kind of followed the same trend from 21 to 22, declined a little bit, maybe up very, very slightly from 22 to 23, but have been about as close to flat as possible from 23, 24, 25. So not seeing any signs of elevated risk, even as we do see increased balances in newer vintages and also some increased draws in some of those old vintages. So seeing very good performance on these HELOCs that are on books and the HE loans on books. So even as we see increases in draws and increases in average balances, not seeing any sort of increased risk alongside that.
Awesome. Yeah, I would say this to fix it. I think, well, I think this is as pristine a credit quality, probably, Steve, as you see across any asset class right now, but right, to contextualize it, right, this is where mortgage delinquencies in aggregate are in the 3 to 4% range, although we are starting to see delinquencies in specific products like FHA, for instance, increase. But yeah, I don't see anything here that is an emergent trend where we think, the bottom is falling out here, or we've got increased, financial duress, et cetera. So Okay, so let's transitioning. We're right on time from our side. Do our best to leave a couple of minutes here at the end for some questions, but I think we're current on the questions that have come through in the chat. But really, kind of what should lenders be thinking about right now, right? Y'all have heard mostly again what we see as an optimistic outlook for home equity lending in the near term. But as y'all are having different conversations internally, and whether that's to double down on the home equity business today, maybe it's a pivot in terms of the products you're offering, or just simply trying to monitor kind of the overall health of your portfolio. So we'll spend a few minutes on this, kind of what's top of mind, what should you be thinking about. I'll start on the origination side, and then Steve, obviously, you can talk more from a capital markets function. But really, for us, on the origination side, you have to evolve, right? You have to adapt. It's borrower needs have shifted. It's a different profile. We had the earlier chart Ken covered on just what's the average household balance sheet look like today. Needs are changing, and I think as home equity has become a more crowded, saturated market right now, and again, how that plays into your acquisition, retainment, strategy or growth strategy right today. You've got to be evolving, and I like, Steve, your analogy on the 31 flavors at Baskin Robbins. Similar composition here, right? How are you going to evolve? What's going to be that competitive advantage? As you think about that evolution, though, simpler is better, right? You want to make the process easy for borrowers. So whether that's a digital offering there, even if you're originating, you're an FI or credit originating at the branch, simpler is better. We're seeing, right, it's not just rate alone that's winning customers. It's certainly the convenience aspect, right? And what is that borrower journey kind of from start to finish? And then lastly, leverage data-backed decisions. You don't want to be operating in a vacuum here. Ken mentioned it earlier. You want to see what's happening real time, how are you understanding, interpreting those shifts, but everything you're doing is informed from the data you're looking at today. And again, where we see growth opportunities, we know kind of the current state of mortgage is a bit more tepid and other asset classes, but we do see from an overall basis, right, a home equity kind of being one of these bright spots. I won't say the only, but I would say one of the bright spots right now in the consumer lending space. Steve, you want to talk about capital markets?
Sure. Yeah, so I think the key thing that I'm seeing as it relates to what originators should be thinking about is just as they enter the space, who are they, back to the consumer side, who are they trying to serve from a consumer standpoint, and then trying to match that with the right investor partners. Because as I mentioned before, depending on whether it's a standalone versus a piggyback, whether it's a HELOC versus a closed end, is it something where the originator wants to retain servicing versus letting the buyer do the servicing? There's all those different variables that I think are different from one buyer to the next. So it really boils down to having more of a partnership discussion and finding the right partner for that, so that you're building the infrastructure on these loans and the docs and everything else to align with that buyer. Because it's not necessarily where it's always going to be portable from one buyer to the next, like would be the case if you're originating other loan types. It's really going to be somewhat buyer dependent in terms of what you're going to do. And so it's just a key to make sure that you have the right alignment.
Right, I'm going to leave our Q&A on the screen, and then maybe a question. I'll pose one for you, Steve, and then maybe one, Ken, for you and Kinley. So we still got a few minutes here. But Steve, you touched on it there at the end. What do you see, though, for those that are looking to maybe get into this space, particularly on the closed-end side? Like, what are the key challenges you think most mortgage banks or new entrants to this space face to kind of get up and start originating and obviously selling?
Yeah, I think part of it is rebuilding a lot of the process, the technology, the documents. It's really, there's a fair amount of operational things that need to happen on the front end, and I think that's important to build into the timeline. And I think that's maybe even more so true on the HELOC side, but it's certainly true on the closed end side.
And then Ken, Kinley, for you real quick, and then Marissa, I'll turn it back to you. Do you foresee, so we talked a lot about product structure with the new entrants, fintech models, full draws, obviously the fee structure as well, typically charging from about 100 to 500 basis points. But Ken, for you and Kinley, maybe quickly, do you foresee depository originators starting to pivot there? Again, from more full draw. You know, we have the 36% utilization metric, right, that we track. But are you expecting a pivot in the near term from depositories? Again, how they look to compete. Talked about it there at the end, how they look to evolve to kind of borrower needs. Obviously, there's an intent behind someone that's requiring a full draw, but maybe comment there if you think that's a potential strategy pivot here for banks.
Well, my very elaborated opinion here, I'll condense down to, I think a lot of depositories are looking at that model, but it's a very challenging model given this is HELOC product is historically a cross-sold product. It's not its acquisition product, but again, fintechs and IMBs are evading that trend and proving that it can be an acquisition tool. But I think it's just much more challenging for depositories given, you know, it's a cross-sell product, it's a relationship product, and how do I sell a fully drawn, you know, required draw type of HELOC when I'm just trying to establish and improve my relationship with that borrower. So
yeah, and it's hard to rock the boat. Nobody wants to be the first one to do it. And you've got your consumers where this has been a cross-sold product for so long. You've got your wealth clients, you've got folks who have deposits with you who want the standard HELOC. If you say we don't offer that anymore, that's where it becomes, oh, well, I'll just go somewhere else. And then it gets to be a tougher conversation.
Great point. Great. I will turn that. Thanks, Ken, Kinley, Steve. And with that, Marissa, I'll turn it back to you.
Yeah, thank each of you for being here today. So sorry for my interruption earlier, but really appreciate you kicking it off so our members don't miss out today. I will now launch our post-evaluation survey. If each of you can hang on for just a minute and give us your honest feedback. You should see that pop up on your screen. There are 6 questions. You'll have to click submit at the end for us to capture those responses. So again, we really appreciate that. If you want to go to the next slide for me, Rich, I have a couple of things I could share with everyone while they're filling that out. So the first one is, of course, that MBA's 2025 Home Equity Lending Study. The highlights publication is actually now available for purchase. So if you originate or service HELOCs or home equity loans, which I imagine you do is why you're here today, this report is going to give a lot of meaningful data about the industry, including growth expectations, and it's all based on 2024 data. So I have linked the study on the slide, and of course, more information can be found on our website. The second one on the next slide, while members of Congress are actually back in their home states, you can take advantage and meet with them in person or virtually. So through MBA's Mortgage Action Alliance, you can actually take part in what's called the Advocacy in August campaign. So it's a national industry effort. It's going to build and strengthen relationships during the August recess. So really great way for you to get involved and meet them in person. Lastly, I know you want to keep hearing me talk. If you're looking to improve your leadership skills and really kind of take that next step in your career, we have a program called Future Leaders. So the 2026 group is opening up soon. Applications will open up August 11th. Basically what this is a networking and learning opportunity with peers just like yourselves from across the country. You'll have virtual and in-person gatherings throughout the year, but it's also a networking opportunity for years to come. So you'll be a part of what we call an alumni group for the Future Leaders. So that's all I have for you. Once you have finished that survey, you're free to go. Again, thank each of you for being here today. We really appreciate it. All right, still getting some responses, so I'll leave the webinar open for a little bit.